I'm joined today by Kevin Marchetti, co-head of Direct Lending and Chief Credit Officer at Man Varagon. Kevin is among the incredible investors sharing insights at the Private Credit Investment Forum today. Welcome, Kevin. It's great to have you with us.
Thank you so much. It's a pleasure to be with you.
Let's dive straight in. How has the private credit market, and in particular direct lending, evolved in recent years? And how do you expect it to evolve in the coming years?
Yeah, it's really been fascinating to watch the private credit landscape evolve over the last, really 7 to 10 years. And really what you've seen is a creation of three distinct markets. You have the large cap space, upper middle market, you have the core middle market, and you have the lower middle market. And what's even more fascinating is within each of those market segments, you've really seen various strategies come up with that are provided by very specific managers. You've got direct lending providers that do sponsored and non-sponsored transactions. You have opportunistic. You have asset-based or cash flow. So it's really been unique to see how the competitive landscape has evolved in each of those market segments. I think that will continue to evolve over the next 5 to 7 years as folks continue to raise more money and there's more opportunity set and differentiated deal flow that's provided to each of those categories.
And what segment of direct lending do you focus on and why is that?
Yeah, at Man Varagon, we focus on the core traditional middle market. And the rationale behind that is really our conviction around three main things. The structure and protections that are provided in the core middle market with financial maintenance covenants and tighter loan documentation. The relationship side of it that we have with the private equity firms that we work with and the differentiated deal flow that drives for our investor base. And then thirdly is the economic side. The illiquidity premium that the core middle market provides versus that of the large cap space, we think offers an attractive relative value for our investor base.
And what is best practice in direct lending portfolio construction from your perspective?
Yeah, I think the way that Man Varagon thinks about portfolio construction is really focused in on recession-resilient end markets. Our goal is to provide investors with durable, consistent returns through multiple cycles. And by doing that, you create and build a portfolio that's based on the most recession-resistant businesses and end markets that we can service. Critical B2B, healthcare, non-discretionary consumer staples in the food, beverage, and packaging space, and accessing that market through senior secured financings at the top of the capital structure to really insulate and protect our investors during periods of economic shock.
How does your approach to direct lending portfolio construction inform your due diligence and risk management processes?
Yeah, we're really focused in on a credit-first mindset. So fundamental primary due diligence is very important in the way we approach the market landscape. So in those end markets that we provide kind of financings for, those recession-resistant end markets, we're really focused in and around the credit fundamentally standing on its own. So durable, consistent, low volatility of the cash flows of those businesses. We're really looking at the quality of the revenue line and the EBITDA line of those businesses, lower level of adjustments, real stable, low volatility on the top line, not exposed to economic periods or cyclical cycles in the economy. And then we're really also focused in on the nuances of those businesses, limited concentration around customers, suppliers, and no industry dynamics that can cause those businesses to have exposure to administration changes or types of legislation risk. So really looking for durable, consistent revenue and focusing truly in on credit fundamentals of those businesses in the due diligence process. And on the portfolio management side, it's really being proactive. Our approach is to ensure that we have a very good grasp on the underlying portfolio accounts in our book. North of 75% of the portfolio accounts that we have report monthly financials. So we're in and around and have our fingers on real-time information for those businesses and proactive dialogue with the underlying management teams at those companies, as well as the private equity firms that own them, allows us to have a proactive approach and stay ahead of any issues well in advance before you have a true problem in your portfolio.
And what questions should investors be asking when evaluating new and existing direct lending manager relationships?
Yeah, look, we're operating in a more interesting time today, right? Over the last 10 years, we're pretty benign. Money was free. It was pretty easy to not have or see any defaults. But I think in the rate environment and the inflationary environment we've operated in, LPs should really be focused in around asking their managers around key KPIs that they're tracking in their portfolio. So revenue trends, operating trends of their underlying portfolio companies, how the interest rate coverage analysis and fixed rate coverage analysis is holding up in their portfolio, and what level of stress testing is that manager doing on those underlying companies. And then also, it's really important to focus in on some key credit metrics. Gross and net losses, how the manager is calculating those, non-accruals, things of that sort. And I think what's really, really important today is that LPs focus in and around not just asking what those KPIs are, but how the manager is calculating those and what they're including or not including in those calculations.
Absolutely. Thank you, Kevin. We're actually going to need to leave it there and get back to the forum, but I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Private Credit Investment Forum.
I appreciate your time. Thank you so much.